Today we're going to start off by talking about one of the most fundamental concepts in market profile, bracketing versus trading environments. We can learn when to identify these trading environments in order to trade within them, and also to identify when they're shifting, as precursors or as it happens. We're going to start with the concept of bracketing and balanced environments. When we see a bracketing or a balanced environments, we're usually looking at passive two-way trade, and it tends to be more responsive in nature. It can sometimes be lethargic in periods of low volume as well. In pure price action, we can also see this as consolidation, compression, ranging, and it usually results in stop runs of over-leveraged positions in BTC. So what we mean by passive two-way flow is that a lot of the time when we're in these ranges, we see this chop and both longs and shorts being able to take control. So we don't necessarily want to be going with the fast-paced aggressive moves, as when we're in a bracketing environment, it tends to be at the extremes, like here, here, and here, when we get the massive moves. And a lot of people tend to be trapped on the breakouts. When people get trapped on the breakouts here because of the aggressive environment, that's when we tend to see this unwinding of positions back into the range. So a lot of people will anticipate these breaks, when in reality, more of the time is spent in this bracketing environment than it is in a trending. Another way to describe bracketing is balance or fair value, which will make more sense after the value area and distribution primer. Basically, price in these environments tends to act within norms, and we have more even length rotations. When we look at a market imbalance, we expect it to stay in balance and fill out the zone, or area, which is what forms the distributions themselves. So we're going to go more into this later, but when we look at this distribution here, right, we can see that time has not spent a lot of time, or price has not spent a lot of time at the edges here. But the wider areas right in the middle, like right here, tend to be filled out more. So when we're in a bracketing environment, we want to see price tend to fill out the middle of the distribution more than the edges, right? Because if we show that we're staying at the edges, that's another sign that we can go into later that price may not have a willingness or strength to travel back into the middle of the range. Why are the bracketing and trending environment and types important? These environments provide frameworks and expected norms to work within when we're framing our setups. We use these environment types to provide context and different scenarios in order to trade not only uniquely, but to take advantage of the certain situations. Anthony Crudell always says, all days are not the same. At the base of these environment types is where it starts. Volatility, risk tolerances, characteristics can change from one day to the next. And so we need to be able to identify this and understand what the major market trading types are in order to take advantage of them. Oops. So bracketing and balanced environments are visible on both the TPO and price action. Many view this as chop or low volatility. However, even this environment serves a purpose, and it's often a precursor to other environment types. So even though a lot of people see this as chop and not really tradable, when we're looking at it and we understand the environment, we can actually even trade the chop itself or scalp in and out of it because we understand what we're working within. And when we get stopped out of these trades or scalping within the range, it gives us more information on what's about to come because we know the compression leads to expansion. In price action, we often view these environments when within previous price legs or high time frame ranges. We can also grade these price legs to create potential range levels, which we'll go into next. So the reason we can see these on every time frame is it's a market dynamic. It's not specific to one asset or one time frame. Ranging, expansion, compression is basically a fundamental of markets themselves. So when we talk about grading price legs and examples, we basically want to find the major leg in price and use simple ranges to understand the expansion and contraction phases. If you want to learn more about this, Trader SZ does a great job of using ranges in his pure price action trading and teaching exactly how to pick the price legs and what to look at in ranges. When we look at these ranges, we can see ranges forming and bracketing price action within the major leg of the impulse. So when we're looking at it, let's get a little line tool here. And we can see that within this price leg here, we have formed ranges. Okay. So within these major price legs, we're then forming ranges, and we can grade the ranges in 100, 50, and 0 increments. We can use this for a basic understanding of where oversold and overbought is relative to the current trading range. So basically when we're looking at these trading ranges, we don't want to be taking trades in the middle of the range. We want to be looking to take oversold trades at the edges of the range and overbought trades towards the underside until the range breaks, right? So we can see here it's starting to revert. So how do we utilize these different trading environments? Once we identify the early environment type, which we will cover later on, we can then form a specific rule set around it in order to trade. First, we identify the characteristic. Bracketing and ranging environments tend to be rotational, meaning we get a lot of two-way price action and more symmetry in up and down legs, right? So we've talked about this before. What we get in symmetry, we mean it's equal size movements and not necessarily equal in dollar length, which it can be, but we tend to mean price action that reverts to the normal. So basically we make a down leg and it reverts back up. We make another down leg, it reverts back up. Makes a down leg, and this one's a little bit overextended and it pops back up, not as deep, and then it pops back up, right? So these are the kind of waves that we're looking at, and it's rotational in nature, and I'm going to say that a lot, rotational, because basically what I'm looking at is something that goes down and it bounces back up and it bounces back down and it bounces back up, and that's what we're basically looking at in rotations, right? So it's the pure market price leg. It has nothing to do with time. It's how far from the bottom we've come, how far from the top we've fallen, and how that relates to the previous legs that we're looking at. So how do we take advantage of these, and what strategies can we employ? So when we understand that the market is more rotational and range bound, and this is going to make a lot more sense when we identify it later when we talk about the value areas, because that's exactly what these are. These aren't just cherry picked ranging days, right? This is exactly like something that I've traded that you can kind of see within this value, right? Because this is where most of the volume is, which we're going to touch on later. We use more mean reversion strategies. We like to use standard deviations, VWAP, bands, anything on the lower time frame that plays out better, right? So when we're looking at the market profile, when we talk about it initially, the main three things we're looking for are context, right? Levels of importance, and anomalies. So once we have our context, which is going to be the part of the environment type, right, we can determine our levels of importance, which we have right here. And then we can use our low time frame strategies. And in this case, because we know the context, we're going to be employing mean reversion strategies, right? We can then zoom down into the lower time frame at these levels and take advantage of that and trade within this range. So I've highlighted basically a couple edges of where we would have been looking to take trades on all of these arrows, right? And I'm not saying you're going to take every single one, and you may get stopped out on a few, but that basically gives us more information moving forward. So now we're going to move on to the next environment type. The second environment type that we look at is trending or an initiative environment. So we tend to see more aggressive movements and injections of volatility. They tend to be quick, and they often are one-sided, and the books thin out if you're watching the ladder. So basically what that means is if we're watching the order book itself and price is being very aggressive, we'll see if it's going up, we'll basically see the asks stacking up, and then we'll see the bids hitting the asks and taking them out very aggressively. And the sell side of the book will start to thin out. So we start seeing movement up and not as many sellers wanting to sell at that price. So if we go back and watch the Auction Market Theory Primer by Tommy, we basically understand that when there's not as many sellers in the market and there's more people wanting to buy, price is going to move up rather quickly, right? So that's basically what we see in these trending or initiative environment types, is because the movements tend to be more aggressive, we do see rapid movements of price, or if traders tend to be trapped on these environment shifts, right? So if we tend to move from a bracketing environment into an initiative environment, we can see a lot of these people who are trying to play the bracket themselves get trapped and end up being fuel for the initiative move. So a combination of buyers being aggressive and sellers getting trapped, we can see quick movements. So we see bursts and injection of volatility, meaning that these things happen rather fast, while bracketing environments tend to be slower in nature and more rotational, like we talked about. these ones tend to be quick and not as forgiving in the sense that they don't give you a second chance entry as much as the bracketing environments will. We tend to see buyers and sellers step in quick on rebounds and pops. So basically what that means is if we're in a heavy selling environment, when price rebounds up, we tend to see sellers kind of give some relief for a second and then step right back in. And on the flip side, if we're looking at an uptrending environment, every time it dips, we tend to see buyers go ahead and buy that up. So that is commonly seen in price action by wicks themselves. We can see these major environment types within each other, as well as price tends to move from balance to unbalance and from balance to unbalance and so on. So if we look at these concepts, right, if we look at these drawings, we can see it's in the tight range, it expands. Tight range, move down, expands. Tight range, expands. And it moves above the range, comes back within, retest there, expands. Range, expands. Retest, expands. Range, expands. Right? So we can tend to see that price moves from one area of balance to the next. And price likes to move once it's out of balance to the next area of balance. So even right here, we see balance, moves out, balance, moves out, and there's probably going to be a destination of some area of balance in here. So when we look at these trending or initiative environments, they can be present on multiple time frames. It's not just like we talked about earlier, it's not just going to appear on the 1 hour or the daily. This is a market concept. So basically what that means is it can happen within each other too. So when we talk about the concept of price being fractal, we're basically meaning that these things happen within each other. So when we look at just this area of price action right here, when we look at it right now, we just see a bracket. But if we were to zoom in, we would see initiative, ranging, initiative, ranging, initiative, and we might even see this as a little range depending on what time frame we're in, right? So we can basically see these concepts within each other, and that's how they play off of each other. When we're aware of key levels on different time frames, so like we said, it may be this could be a 15-minute chart, right? And we could be looking at major levels here. We could be looking at a major level there and a not so major level there, right? So let's say this is an hourly level and this is a daily level. So we're going to go ahead and annotate that out. Okay, and this is going to be daily SR. And so why we want to be aware of these different levels is we may want to be aggressive and say, okay, it's starting to chop around this hourly SR level. Maybe we want to try to find an entry somewhere in here to try to ride it up to this daily level, right? But once we know it's above this daily level, we can kind of see a lot more people are going to, or not kind of see, we can basically anticipate that a lot more people are going to see this breakout because of this daily SR level, right? A lot of people are looking at the same levels. So if we're looking at the higher time frame levels, we may have bigger participants stepping in. So when we see a break of this level, I may be more inclined to think we will get a bigger rally up than if we were to just break this level, right? And this isn't cherry picked or anything like that. This is just an example based on, okay, when we're looking at different time frames, the higher time frames are going to involve higher time frame players, and if not higher time frame players, they're going to involve more players, right? Because more people are going to be looking at the higher time frame charts than going down. And the same thing applies if this were a 5-minute and an hourly level, right? We would just want to be looking at, okay, if everyone's looking at the same level, where are people going to be stepping in, or where are people going to be trapped? So if we think this is an hourly level and it breaks here, I'm not going to put the same weight on this breakout as I am on this, versus if this failed right here and it broke out here, I'm not going to still stay bullish, right? Because if we broke out of this hourly level and we were to reject right here at this daily level, that's more telling than this, right? So that basically warns me that we have a potential environment shift and we could be coming back down here. So knowing when to employ these strategies and knowing when to switch trading strategies based on the importance of the level and the context at that level is one of the biggest thing that's been able to help me and change my trading personally. So how do we utilize the trending environments or initiative environment types? We basically look to employ trend following strategies, which is MAs, right? Any oscillators, any Heikin Ashi, anything special like that, right? So any trend following strategies is what we kind of look to use these different levels on, because we can basically see that they don't give you a lot of opportunity sometime to get back in. So there's no perfect retest that a lot of people are going to be waiting for, where they want to see something like this, where it breaks out of this range right here and it comes down, and they want to see this retest before it sells off, right? But a lot of the time, you're not going to get that in these trending and initiative environments. And that's why it's really important to know what type of level it is as well, because if it's an hourly level, right, you may get that little rounded retest. But if it's a really strong daily level and it breaks it with strength, we may not have the strength to actually come back up and retest it, right? And it's going to leave in this void to fill in later. So we're going to talk about those voids later as well. But based on if this is a daily breakout level, let's just draw it a little level right here. Based on if this were a major high time frame level or a daily level, and we're looking to go with it, right? And this is what we're going to talk about in a minute, go with versus staying patient for entries. We're going to be using our low time frame tools, our MAs, all of that good stuff to hop on board that, because we know that once this daily level breaks, there's a higher chance that it's going to continue versus playing the ranging environment. So this is where we use bracketing and trending and environment shifts to our advantage, right? So like we said, if it is a heavy trending environment downwards, so if we are looking for continued selling downward, we should basically see when price does pop up, we should see heavy selling into this spike right here. So this is a really good way you can take advantage of this, right? Because as soon as we have a pop back up that fills in this void, and we're going to talk about these liquidity voids later, right? This is where you want to be looking for your short. And if you're not taking that short right there, as soon as that happens and it gets rejected, you want to be slamming the market right here, right? And this is where you're using your other low time frame context tools, your order flow, your MAs, any of that kind of stuff. And this is what we talk about when we say go with versus staying patient. So go with basically means when we see a breakout, you're getting involved in that breakout. You don't need to see a rounded retest, because we know the strength of this move and we know the context behind it, which is that this is a daily level. This is a very important high time frame level. And that's why we have to be able to take advantage of it, because you're not going to get a very clear rounded retest sometimes when we do have these strong breaks, because there's just not enough strength to push it back up. So we have to be able to recognize this as a weakness and then take advantage of it. And that is today's lesson on bracketing versus trending. Hope you guys enjoyed it.